Good morning, everyone. We will allow 2 minutes for the others to join in, and then we'll get started with today's session. Okay, all right. I think we can get started. Good morning once again. Just put a yes or a Y if you're able to hear me clear and loud. Excellent. Thank you. So today we are going to do the gross income overview. Remember, we went over the formula yesterday, how to calculate the taxes for an individual. So we start with the gross income, then we have the adjustments, we get the adjusted gross income. Then we have the option either to take an itemized deduction or to take a standard deduction. We also have qualified business income deduction available. And then we arrive at our taxable income. We use our applicable tax slab to finalize our tax liability. And then if we have made any payments or if there are any credits that are available, that is going to reduce our tax liability, and ultimately we'll either have a payment due or a refund from the government. All right. Again, reiterating that if you have any questions, please keep it during the last 15 to 20 minutes of your session, and I'll take up all the questions then. If you put your questions while I'm teaching, it kind of distracts me and I will also miss out on answering those questions, all right? Someone who's not attended my class yesterday, again, to let you know how the class flow is going to be, I will use the first 1 hour, 15 minutes to go over the content. Everyone will be on mute, and then we will use the last 15 to 20 minutes. I'll keep the forum open for any questions that you may have for the content that I've covered today or the contents that I've covered yesterday. All right, makes sense? So yesterday what we did an overview of the filing status. So basically we understood who needs to file, when do they need to file, what is the extension that is available, what are the filing statuses, and who can avail what kind of filing status. The one that had additional requirements was the qualifying widow or widower and the head of household. We also understood the definition of a qualifying child and a qualifying relative and the multiple support test. Today, we are now going to dig into the formula of the, I still see people posting questions. Again, requesting, please keep these questions for the last 15 to 20 minutes of your session and I will answer it. Do not post your question now because it's going to distract me. I'm going to explain the content now. Please keep those questions for the last 10 to 15 minutes of the session. And I have taken all the questions that people had yesterday. All right. So going back to the content, today we are going to do an overview of the gross receipts. So in the gross receipts section, we are going to cover what income needs to be included as your taxable income. You'll also see that we will come across certain items wherein there is a reporting requirement, but there may not be necessarily a taxation on those income. So there will be some income that is exempt income. That means you do not pay any taxes on that income, but you still have to go ahead and report that income on your 1040. All right. So anything that is not specifically spelled out by the Internal Revenue Service is an income and you need to pay taxes on it. All right. Gross income includes all income from whatever source derived unless specifically excluded, unless the IRS is mentioning that you should not include that as an income. So even if you find $4,000 on the floor and you cannot find the owner of the income and you keep the income, you will have to pay taxes on it. Now, one important aspect of the taxation is that whenever it's a taxable transaction, we consider the fair market value. Whenever it is a non-taxable transaction, we consider the net book value. Now, what is a fair market value? What is a net book value? We will build on these concepts again when we go to the entity transactions, the entity taxations. So fair market value, for the benefit of everyone, is the current value of the asset. Like if you sell that asset today in the market, what is the price that you're going to fetch for that asset? Net book value is the value which you have invested to purchase the asset and any adjustments that you have done. So net means that it is adjusted for any appreciation or any depreciation, right? So let's say if I buy a house today for $10,000 and then I do, make let's say a shed over the house and I spend $2,000, which is a capital expenditure, what is going to be my net book value of the house? So 10,000 is the initial purchase price. And then I have done a construction, which is $2,000 of a capital adjustment, right? So the net book value of the house is going to be $12,000. And if the current value of the house is $20,000, so that's my fair market value. So remember that whenever it's a taxable transaction, you consider it as fair market value, and whenever it is a non-taxable transaction, we consider it as a net book value. Sometimes not only the cash that you receive is part of your gross income, but any services that you have rendered, the fair market value of the services are also your gross income. Okay. So a taxpayer performs services and receives a car with a fair market value of $3,000 as compensation. So, the fair market value of the car is your gross receipts and you need to pay taxes on it. Okay. So let's say, for example, that I'm teaching at Simandar and then I take a AI course from Simandar. I say that you don't have to pay me for the classes that I'm conducting. Instead, give me the AI course that you're offering, and it is for $500. In this case, what is going to be my gross income from the teaching profession at Simandar? It is going to be the fair market value of the AI course, which is $500. Okay. Now, two very important concepts. And remember, I had told you this yesterday that there are a lot of concepts that we are going to cover in individual taxation. And these concepts will be repeated and we will build on more on these concepts when we move forward in our syllabus. So there is a realization event and then there is a recognition event. Realization event is when there is an exchange happening, when there is a transfer of title that is happening, when you are, getting cash for the exchange of the assets. Recognition is when you are actually recognizing the income and paying taxes on that income. Okay. So realization, sometimes what will happen is that there will be a realization event, but there may not be a recognition event. When we do chapter 2, you will see that like kind exchange, which is, which we are going to do, wherein sometimes the income is deferred or the losses are deferred. You will see that like kind exchange assets, when you exchange them, there is a transfer of title, right? Because you are giving your asset and receiving another asset. So there is a transfer of title, there is a realization event, but if there is any gain or loss that you have realized, you will not recognize that immediately because it's a like-kind exchange. So in those scenarios, there would be realization, but not recognition. Okay, so recognition is that when you actually include the gain or the loss on the tax return. So we look at this example here. The taxpayer owns stock for which he had paid $100 and the stock goes up in value to $150. There is no realized gain even though there has been an increase in the taxpayer's wealth. Why there is no realization event here? Because I'm not selling my stock. The stock is going up and down because there is fluctuation in the market, right? Gain is realized when the stock is sold for $150 or exchanged for other property worth $150. If the gain is taxable, it would also be recognized on the tax return. All right, so we do have methods to account for the income. There is accrual method and then there is cash method. Accrual method, you recognize income as and when you accrue it. Cash is when the cash comes in, it's income. When the cash goes out, it's an expense. The next gross receipt, uh, items that we are going to move on. There are a lot of items that you're going to see here. And you will see that we will focus mostly on the items which are either you can defer it or you can exclude it. So your salaries and wages, they are all income. Now, salaries and wages can be in the form of cash, it can be in the form of property, and it can be in the form of bargain purchase. All right. So let's say that I'm working at Simandar, I'm taking these classes, and instead of paying me cash, Simandar is sending me a software for my AI certification, which is worth $1,000. So what is my compensation that I should include it in my income and pay taxes on it? So they have not given me any cash, but they have given me a software which is worth $1,000. So here they are giving me an intangible property. So whatever the fair market value of the intangible property is, that is my gross income. You will see a lot of time there is a bargain purchase that happens. Bargain purchase means that you are getting asset which is less than the fair market value of the asset. Okay. So let's say that you are a CEO of a company and the company that you're working is a Mahindra and Mahindra, right? So you want to buy a truck. The fair market value of the truck is, let's say, $10,000, but because you are a CEO, they are giving you the truck for $5,000. So there's a bargain purchase of the truck which is less than the fair market value of the truck. So here in this scenario, what is the income that the CEO has to pick up and pay taxes on it? The difference between the bargain purchase and the fair market value of the asset, which is $5,000. Okay. Salaries and wages, sometimes our employer will give us some fringe benefits. Now, these fringe benefits, IRS has spelled out, specifically what needs to be included in your taxable income and what can be excluded from your taxable income. Guaranteed payments to the partner. How many people have heard about the guaranteed payments? Okay, if people have not heard about the guaranteed payments, now this is a concept which is applicable to partnerships. So in partnerships, if the partner is infusing capital or if he's providing services, then they provide certain payments to the partner. Why it is called guaranteed payment? It is called guaranteed payment because irrespective whether the entity is making profit or not, you will get this payment. So even if the partnership is making losses, because you have infused capital or you are providing services, irrespective of the loss that the entity is making, you will still go ahead and get these payments. So that is the reason they are called guaranteed payments. So the guaranteed payments are also taxable income for the partner who's receiving it, and it is also subject to self-employment taxes. Now, there are a lot of taxes that we are going to come across. For most part of it, for the 90% part of our syllabus, we are going to focus on the federal taxes. So federal taxes are the taxes that are assessed by the Internal Revenue Service. In United States, there are also state taxes. That means depending upon the state that you are staying, you may also have to pay state taxes, barring, I think, 4 or 5 states. The rest of the 45 states assess taxes on the income that you generate. Apart from that, we also have additional taxes like the self-employment taxes. So self-employment taxes, I'm going to explain you self-employment taxes with a calculation when we go to Schedule C. A Schedule C is basically the schedule where you report all your business activity. So if you are a proprietor and you are running a business, you also have to pay self-employment taxes on that proprietary income. And this is made of Medicare and Social Security. Now, if you are in an employer-employee relationship, then the employer is paying the 50% of the FICA taxes and the employee is paying the 50% of the FICA taxes. Because you are self-employed here, you pay the both employer and the employee portion. The terminology is different. When you are in an employer-employee relationship, we call it as a FICA taxes. When you are self-employed, we call it as the self-employment taxes. But they are both made of the same taxes, that is Social Security and Medicare. How much is Social Security? How much is Medicare? What is the percentage? On what income it is assessed? That's something that we will cover when we go to Schedule C on the self-employment, the business income. Moving on to tangible fringe, taxable fringe benefits. Fringe means that it is very small. It's negligible benefit, but certain benefits that you receive from your employer, you may have to include those benefits and pay taxes on it. So unless you read about certain benefits that is not taxable, consider that all the other benefits are taxable to the employees. So let's say if the employee is using the company's car, that usage of the company's car is included in its wages. And it is also subject to the self-employment taxes, which I mentioned is the Medicare and the Social Security taxes. We'll also come across the retirement plans. So there is 401k retirement plan, there is a Roth IRA plan, and then there is a traditional IRA plan. So 401k plan, can be a defined contribution plan, or it can be a defined, other plans wherein depending who is taking the risk, whether the risk is with the employer or whether the risk is with the employee. If you have chosen, TCP as your discipline, then when we do TCP, that is where we are going to cover more in-depth information about the IRA plans that we have. Now, if the employer contributes to the Roth IRA account. Now, what happens in a Roth IRA account? Mostly when we contribute to a IRA, the retirement plan, we get to take the contribution as a deduction on the tax returns, which helps us to reduce our tax liability. But that is not the case with all the IRAs account. So if you have a Roth 401k IRA, then the contribution that you make in this IRA account, they do not provide you immediate tax benefit, and the contribution needs to be included in your income and you need to pay taxes on it. All right. I just mentioned, Weeble, that it is a retirement plan. And again, reiterating that if you have any questions, please keep it for the last 15 to 20 minutes of the session. So it's a retirement plan if your employee, if you're contributing any money against this retirement plan, it is not going to give you any immediate tax benefit. So you will have to include this in your income and pay taxes on it. And then later, when there are distributions, when you attain the age of 59 and a half, if you can pull money out of this account, any principal and any earnings that you have on the principal is basically tax-free. So that means you do not get immediate tax benefit, but later when you withdraw the money, there is no taxation on the principal and on the earnings. Now, sometimes you will see that our employer will also pay for some life insurance premium on behalf of us. Okay. So if the coverage of the life insurance is up to $50,000, then there is no, like the premium that they are paying on our behalf, you don't have to include that as an income and you don't need to pay taxes on it. Okay. So let's say that the employer is paying $500 for for an insurance coverage of $50,000. Now you got promoted, you are now a senior manager, and the insurance coverage has gone up. It is $70,000, and now the employer is paying $700 on your behalf as a premium for the life insurance coverage. In this situation, what portion of the premium will be taxable for you? So let's say for each $10,000, the premium is $100. So now you got promoted, you're a senior manager, your coverage is $70,000 and your employer is paying $700 as a premium on your behalf. So we said that the first $50,000 of the coverage is not included in your wages, and the premium that you pay over and above the $50,000 is going to be your taxable income. So the $200 excess that the employer is paying now, that's going to be taxable, and that you need to include it in your taxable income. This is where you should be focused upon, because we would like to know which income is not taxable. So non-taxable fringe benefits, if your employer is paying any premium on your behalf for any medical, accident, and health insurance, those premiums are not included in your income. However, if you withdraw money from the policies that for which they are paying the premium, and the amount is not used for qualified medical purposes, then that amount is included in your income and you have to pay taxes on it. Okay. So let's say that there is a medical insurance. And if you're claiming the medical insurance because you got hospitalized, or there was any surgery, there was any permanent loss of any function of the body, like you lost a limb or anything like that, then the amount is not includable in the income. But if you use it for disqualified purposes, let's say you just use the medical insurance to buy a bunch of cosmetics which you think is going to help you have a better skin, then that amount will be like non-qualified use of the medical insurance, and you will have to include that as an income and pay taxes on it. Then we have the de minimis fringe benefits. De minimis fringe benefits means that they are so minimal, that they are so negligible that you will not be able to measure the benefit that someone is receiving out of it. Okay. So let's say that Lisa, I'm just calling out your name, so don't take it personally. So let's say Lisa is working in one of the MNCs, and Lisa loves to watch movies. Okay. So most of the time she's working, and every day, 10 minutes she designates to watch some, let's say TED Talks on the YouTube. So she is using the company's laptop to watch something that is of her personal interest. Can you gauge what is the benefit that she's reaping out every day by watching 10 minutes of YouTube? It is impossible for us to do that, right? So if you're using your company's laptop for any personal use, obviously those are very minimal. You will not be able to gauge what is the benefit a person is receiving. So those benefits are not taxable. Sometimes what happens is that your employer will provide you meals and lodging. Now, let's say that I'm working in an industry where it is important for me to be at the site. So let's say you are a construction engineer, or you are an engineer who is located in a site where you have to I would say, like the oil mining or coal mining. So there, your physical presence is needed because it is a requirement for the job. So if meals and lodgings are provided because it is required for you to perform your services there, then it is non-taxable for the employee and they don't have to pay taxes on it. Now, there are also other benefits which the employer may provide to the employee, and those are not taxable. So, if the employer is paying for the educational expenses of an employee, you can exclude up to $5,250. Okay. Now, remember, you do not have to go gaga about remembering the numbers here because all these numbers, they are adjusted every year for inflation. So this is the number for 2023. Now there could be a different number for 2024. All right. So the crux here is, or I would say what is important here is that you know that there is an exclusion that is available, but you may not have to focus too much on remembering the numbers. Okay. So exclusion of this 5,250 applies both on undergraduate and graduate level education. Now, if you are adopting a child, then certain expenses that are related to adopting a child, which are reimbursed by your employer, those can also be excluded, which is 15,950 for the year 2023. However, this adoption expenses can phase out if your modified adjusted gross income. Now, these are all fancy words that they have used, but we will try to decode it. So, remember that when we saw the formula yesterday, we said gross income minus adjustments, or we also call it above the line deductions, will give us the adjusted gross income. Modified, M here stands for modified. Modified adjusted gross income means that apart from the formula that is listed there, there may be certain other additions or subtractions that you have to do in order to arrive at that number. Okay, so if someone's modified adjusted gross incomes fall under the bracket of $239,000 to $279,000, then this benefit will start to phase out. So basically 239 to 279 is the range that they have mentioned. So if you are someone who has a modified AGI of less than $239,000, you will get the full exclusion. If you are someone whose AGI is more than $279,000 to 30, then you will not get any benefit. Okay. But if you are someone who's falling in between the range. So what is the range here? If someone can quickly do the calculation and give me the number. What is the range here that is listed? Excellent. The range here is $40,000, right? So if someone is falling in the range between 239 to 279, they will be given certain benefits. So they will be allowed to take certain expenses and not the entire expenses. Okay, so let's say if you are falling in between the range, like 50% in between the range, then instead of you getting the entire $15,000 of exclusion, you may just get, 7,500, like that. This concept is very important because you will see that we will repeat this time and again. Reason is that certain benefits that the IRS is trying to provide is for the people who are not making a lot of money. We also call it the Robin Hood rule, which means that these provisions are there for the people who are not very rich people. So as and when your adjusted gross income goes up, certain benefits starts to phase out. And remember, I had mentioned this yesterday that adjusted gross income is a very, very important number because that number is used to determine whether you're going to get certain benefits, whether you're going to get certain deductions, or whether certain benefits are going to phase out. All right. Now, dependent care assistance. You know that the world is changing and, both the husband and the wife, they are working, but you still have kids. So if you want to take care of your kids, you may have to put them into nursery or into daycare. So if you incur those kind of expenses, and it has been reimbursed by your employer, then up to $5,000 of such benefits can be excluded from your income. Now, qualifying dependent, here they have mentioned that the child is under the age of 13, or you have a spouse or other dependent physically or mentally incapable of self-care. Now, why was it important for us to understand the definition of a dependent child and a dependent relative? Is because of these benefits, right? So here when they say dependent, other dependents, now this can be your dependent relative. And here if you see dependent child, they have modified the definition. In the definition that we studied yesterday, what was the age limit for a qualifying child? The age limit for a qualifying child is 19 years, and it was 24 years if you were a full-time student, right? But what is the definition here for a dependent child for you to claim the dependent care assistance, to exclude the dependent care assistance reimbursement from your employer? It is now modified to 13 years. So this is what I was trying to mention yesterday, that most of the definition of the qualifying child or the qualifying relative will be the same, but there would be some tweaks that will happen on different concepts that we are going to cover over the period of time. Okay. Then we also have tuition reductions. So if there are any tuition reductions that are provided, it will depend whether you are giving it to an undergrad student or you are giving it to a graduation student. So for undergrad student, they can exclude that tuition fees reduction. They don't have to pay any taxes on it. But if you are giving it to a graduate student, then they can only exclude the reduction if they are also engaged in the teaching and research activities, and the reduction is in addition to the pay of the teaching or research. So only if they satisfy these requirements, that is when they can go ahead and exclude the reduction. Otherwise, they will have to pick that up as an income and pay taxes on it. All right. Merchandise discount. So let's say that Karan is working in Amazon, okay? And Karan wants to buy an iPhone. Because he's an Amazon employee, he gets a discount of 10%. So in that case, will Karan have to pick up that 10% discount as an income and pay taxes on it? Yes, no, maybe? No. So a lot of people are saying no. But how do you determine whether he has to pick up the discount as an income or not? So usually the discount is excluded, is limited to the employer's gross profit percentage. Okay. So let's say that the profit percentage on the Apple phone for Amazon is 20%. Okay. If I would say Karan is just getting a 10% discount, then there is nothing that he needs to do. But let's say that Karan is a very celebrated employee of Amazon. So they give him 25% discount, but their gross profit margin is only 20%. then in that case, will he has to report any of the discount as income and pay taxes on it? The answer to that is yes. The 5% excess that he's getting over and above the employer's gross profit percentage, that is going to be taxable for him and he's going to pay taxes. Service discount. Okay. So let's say that I work in a parlor and I love to get my nails done. I love to get my nails done every week. The parlor is providing me 50% discount on the services because, you know, I do a very good job at parlor. Then do you think this discount that they are providing is going to be taxable for me? So usually 20% of the discount on the fair market value of the services is excluded. But if they are giving me 50% discount, then the 30% of the discount on the fair market value of the services is going to be taxable for me, and I need to pick that as income and pay taxes on it. Sometimes your employer will provide you the parking fees benefits, they'll reimburse you for parking. So you can exclude up to $300 per month for the parking benefits. Exclusion is available even if the parking benefit is taken by the employee in place of taxable cash compensation. Transit, what do we mean by transit? What is the name that we use in India for transit passes? Convenience. Public transport. Okay. Toll tax. Yes. So transit passes, again, it is related to travel. So usually it is like the toll tax that we pay. So those transit passes up to $300 per month can be excluded. Again, don't spend too much of time remembering the numbers, but you should remember the concept because these numbers, as I mentioned, may be adjusted every year for subject of inflation. Now we come to the qualified non-Roth retirement plans. So again, these are the retirement plans. Some of the retirement plans, when you put money in those plans, or your employer is putting money in those plans, you may get immediate tax benefit. That means it is going to reduce your taxable income. But sometimes you do not get immediate tax benefits depending upon what plan you are investing in. So non-Roth retirement plan means if you invest in a Roth plan, which we just did, a 401k Roth plan, there if you contribute, you do not get immediate tax benefit, but the distributions and the earnings on the principal is non-taxable when you take distributions out of that plan. Here, if you are putting in a non-Roth retirement plan, then it is not considered as an income to the employee at the time of contribution. Okay, so if let's say, your employer is putting $2,000 for you, that $2,000 may not be considered as an income at that point in time. If you are contributing, okay, so if you are contributing to the non-Roth IRA plan, then you can take that as a deduction. Like it's a pre-tax deduction. That means you don't pay taxes on it and you don't consider that as an income. But what happens that when you receive the distribution out of this plan, and if there are any income that you have generated on the principal, both are going to be taxable for you. Then we also have the flexible spending arrangements. Now, flexible spending arrangements is a very famous concept in the United States because you can put money in these plans, and this is a pre-tax money that you can use to pay for your medical expenses. So let's say that, I have decided to get braces. And I anticipate for the next 3 years, I'm going to have a medical expense of $3,500 every year. Okay. So if my employer is having a flexible spending arrangement plan, I can put money in that plan. So what is going to happen is from my salary, they are going to, whatever I want to put in. So let's say I decide to put 2,500 of my salary to the FSA plan. So what is going to happen is before that income gets taxed, they are going to set aside that 2,500 and then they are going to pay the remaining income to me on which the taxes will be levied. So this 2,500, which is a pre-tax amount. I hope everyone understands what is a pre-tax amount. Pre-tax means that there is no tax that you've incurred in this amount. So you can use this amount directly to pay for any medical expenses. So in my example, if I am going for my braces or for my dental treatment, then I can use this 2,500 and pay for my medical expenses. Otherwise, how does it work? First, you make money, then you pay taxes on it. Then the post-tax money you use for your medical expenses. So this is one benefit of an FSA where you can have the pre-tax money being used for your medical expenses. There's also some drawback that I anticipated that my expenses are going to be 2,500, but I just ended up spending $1,000. So generally, I can roll over only up to $610 in the next year. And if the funds are not used within 2.5 months of the next year, then the funds are forfeited. Okay. So what are we doing so far? What are we learning so far? Which section of the formula are we in? We are in the gross income section. So you see, we are learning all the components of the gross income, which is taxable, which is non-taxable, which is tax exempt, but there is a reporting requirement. Okay. Now we'll speak about the interest, dividend, and gains. Interest income. Now, unless IRS is telling you that this interest income is not taxable, everything is taxable. So interest that you get from your industrial bonds, from your corporate bonds, from the installment sale. Is everyone aware what is an installment sale? Yes, no, maybe. What are you saying? People, you don't know installment sale? You've never bought equipment from Bajaj Alliance on EMI? No concept. Haven't heard about what is an EMI. So installment sale is something like a EMI only, where you don't pay everything upfront for the product, but you pay it over the period of time, right? So let's say that I want to buy a 52-inch TV. I love to watch TV. In reality, I don't. But now that TV is going to cost me 1 lakh. So we'll convert that into US dollars. So let's say that's going to cost me like around $10,000. Okay. Now I don't have that kind of money. So I'll go and buy it on installment. So let's say I'm going to pay the installment for the next 3 years. So in this case, there will be an interest component as well, right? Because I'm going to pay the money in parts. So that interest that I have to pay on this installment purchase, a person who's receiving the interest, for him, it is an income and he has to pay tax. He or she who's receiving the income has to pay taxes on it. Interest paid by the government because they were late on paying your refund. So usually, what happens is the refund process in the United States is it's not bad. Like you usually get it in 30 days or 40 days. But let's say it took them 1 year for you to get the money, the refund. So whatever interest you have accrued on that income for 1 year, they're so nice, they're going to pay interest on that income, like on the refund. So that interest, if you get from the government, that is again income for you and you need to pay taxes on it. Sometimes there is, bond premium that you pay. So any amortization on the bond premium is also considered as interest and you pay taxes on it. Okay. Interest income. Now, this is important. Tax exempt interest income. Reportable but not taxable. Okay. Once we finish doing the gross income section, or I would say we'll finish some parts, some components of the individual taxation, I will also show you how the 1040 looks like and where would you report what kind of income. Most of the forms are very self-explanatory. Like if you read the form, you will know what to put in those sections. But still, for the benefit of everyone, we will go over the form once we are done covering most of the components of the individual taxation formula. So certain incomes are not taxable, but you still have to go and report it on your 1040. So what are those income? Your state and local government bonds obligation interest. So basically your municipal bonds interest and bonds interest on the US possession. So please be very thorough with this, especially for the interest which is non-taxable. Then we also have interest from the US Series EE Savings Bond. Now, US Series EE Savings Bonds are issued for, people who are saving for their higher education. So if you invest in a bond and if you are receiving any interest on these bonds, then this interest is not taxable, but you still have to go ahead and report this interest. However, in order for this interest not to be taxable, you will have to satisfy certain conditions. So let's say, what are those conditions? It is used to pay for your higher education. So the bond the interest on the bond that you have earned is issued after 1989 and it is used to pay for the higher education of either you or your spouse or your dependent. So why dependent, qualifying relative, qualifying child, dependent definition is important? Because of these, right? So we know what do they mean by dependent here. The taxpayer should be over the age of 24 when the bond is issued and is married taxpayer files a joint return, which means that if you are a person who has bought the bond and you are a married individual, you should not be filing as married filing separately. What will happen if you do married filing separately? What will be the repercussions here? Your interest is going to become now taxable. That is the repercussion. Okay. The taxpayer meets certain income requirements. That means, they have not mentioned in details, but again, if you have certain disqualified income or if you make a lot of income, then you may not receive the benefit or the interest will become taxable for you. Tax exempt income reportable. Again, we are still on the interest for US Series EE bond. Here also, this benefit is subject to phase out. So if you are married filing jointly and your modified adjusted gross income falls under this, then it is going to phase out and your interest is going to be taxable. If you are single or you're head of household, then your modified adjusted gross income is in this category. Now, can anyone tell me what is the range for the single or head of household? What is the range that they have listed? 1,500 or 15,000? So the range here is 15,000. Excellent. So if let's say that I'm single and I have $100 of interest from these US Series EE savings bond. will I be able to exclude the interest income if I satisfy all the other requirements? My adjusted gross income is only $90,000. If my adjusted gross income is only $90,000 and I satisfy all the other requirements, I will be able to exclude the $100 of tax exempt interest income. But let's say if my AGI, modified adjusted gross income, is $120,000. Now what's going to happen? Now I fall out of the range. So in this case, I will not get the benefit. So it's going to become taxable for me. And what happens if I fall in between the range? Then I might be able to exclude certain component of the interest as non-taxable, and certain component of the interest will become taxable. Okay. Interest income. Interest income from the savings account, or sometimes you'll see that we will put this fixed deposits. Now, fixed deposits, if you put it for 5 years, but let's say you have a contingency and now you want to withdraw the money from that fixed deposit. So obviously there will be some component of the fixed deposit that is going to be, they are going to, like, let's say the interest component was 5%. Now, if you're breaking the fixed deposit and taking the money before the duration of the fixed deposit, obviously they are going to penalize you, right? They are going to assess some penalty and they may not pay you the entire 5%. So what they are trying to say is that if there is any penalty on the early withdrawal, do not set off this penalty with the interest income that you have generated on the fixed deposit. So they should be reflected at two separate transactions. So let's say your interest that you earned on the fixed deposit were $100, and because you withdraw it early, there's a penalty of $50. So what they are saying is, include the entire $100 as an interest income and report the penalty separately, $50, under the adjustment section. Do not net the penalty and the interest and report as $50 as interest income. So it should be reported as two separate transactions. Dividend income. Now, dividend income, we all know, how do we get dividend income? From where do we get dividend income? Who gives us dividend, people? If we invest in corporations, right? If we invest in corporations, they are the one who are giving us the dividend income. Now, we are going to build on the concept of dividend in a extended way when we move to the entity transaction or entity taxation in chapter 3. So usually when the company makes money, that's when they give dividend income. So how will I know whether the company is making the money or not? What is my way of knowing whether they have made enough profits to give distributions to their shareholders? So we look at the account which is called the earnings and profits account. Okay. Earnings and profits account is like a bank account, because retained earnings, that's a good answer, Amar. But retained earnings does not account for any taxes that you have paid, or any limitations on the deductions which was not allowed. Because see, the payment to your shareholder should be on the cash that you actually have in the company. So let's say when you're paying federal taxes, right? That cash is not with the company. So if you are making any payments based on the retained earnings, that may not be the correct cash balance. So you look at the earnings and profits. So earnings and profits is adjusted. It's like a bank account, the actual cash that is lying with the entity. So if the earnings and profit account is positive and there are any distributions, that is dividend income to the shareholder, which is taxable. If the earning and profit account is negative, that the company never made any income, but they are still distributing money to the shareholder, then what is it? You invested in a company, let's say ABC. ABC is in losses for the next 10 years, but for the last 10 years, but they are still giving distribution to the shareholder. Then basically what they are doing is they are returning the capital that they have infused in the building, like in the entity. So it's a return of capital. So let's say I invested $100 and they have distributed $110 to me. So in this case, what is going to be the implication? First of all, they don't have any positive earnings and profits. So the entire $110 is not dividend income to me. Because I invested $100, they are giving me $110. So they are giving me more than what I have invested. So up to $100 is my return of capital. So there is no tax implication on that. But the excess that I'm getting, the $10 excess that I'm getting, because I invested only 100, you are giving me 110. So that $10 that you're giving me is my capital gain, and I will have to pick that up as a capital gain and pay taxes on it. We will have an in-depth discussion on this distribution from the earnings and profits. What is current earnings and profits? What is accumulated earnings and profits? What happens when the accumulated earnings and profits is positive, the current is negative, and vice versa? We'll do all those scenarios when we go to the corp chapter. But for now, for individual taxation, understand that you usually get a form from the company who's giving you the dividend. They will issue you a 1099 div. That's the name of the form, which will clearly state whether it's a distribution of the dividend, whether it's a return of capital, or you will also have to see whether it's more than what you have invested and whether you have to pick that up as a capital gain or not. Now, dividend income is taxable. So if you are receiving cash, the cash that you receive is taxable. If you are receiving property, whatever the fair market value of the property, that is taxable for you. So let's say you've invested in Apple. Okay. So Apple says that instead of me giving dividend to my shareholders, I'm going to give you the latest Apple iPhone Pro Max 15. I'm going to give all that to my shareholders. So in that case, what is going to be my dividend income? And let's say Apple has enough earnings and profits. They have all positive earnings and profits. So in that case, whatever the fair market value is that of my iPhone Pro Max, that is going to be my dividend income, and I will have to pay taxes on it. All right. Another important concept that we are bumping into is the preferential tax rate. Okay. Preferential tax rate. And this is a terminology that you should all keep a note of. Preferential tax rate means lower tax rate than your regular tax rate. So we all know by now that the tax rate for an individual is progressive. So as and when the income goes up, the tax rate also goes up. Okay. So let's say if Harsh is making $1 million of income, he will probably have the highest tax rate of 37%. But if Harsh is generating any dividend income and the dividend income is a qualified dividend. What do we mean by qualified dividend? Qualified dividend means that you have satisfied the requirement to keep the stock at least for 60 days from the ex-dividend date. So 60 days before the ex-dividend date or 60 days after the ex-dividend date. So if you satisfy the holding requirement, then it becomes a qualified dividend. If it becomes a qualified dividend, instead of Harsh paying 37% tax on it, he will pay a preferential rate, which can be 20% only. So he gets a 17% leeway on the income that he generates through dividend. That is what we mean by preferential tax rates. That means you pay less tax on this kind of income than what you have on the. Why people are trying to on their video? Let me just disable that feature. So you pay less taxes on this kind of income than what you will pay on your regular income. Now there is qualified dividend and then there is ordinary dividend. Ordinary dividend means that you have not satisfied the holding requirement. So let's say you kept the dividend only for 5 days, or you held the stock only for 5 days or 10 days, or you've not met the holding requirement. In that case, it will be an ordinary dividend and you will have to pay the same tax rate as you pay on your normal income, which will be 37%. Now, what is non-qualified dividend? Non-qualified dividend means that you don't get preferential rates. So all the items that are listed here, short sale positions, certain foreign dividends, dividends from credit unions, mutual fund banks, they are all non-qualified dividends, so they will not be taxed at a preferential rate. Okay. So this is the table again, which lists down the tax rates on the qualified dividend. So it can be as low as 0% and the maximum that it can go is up to 20%. So as I mentioned, if I'm giving an example of Harsh and Harsh is single, if he is making $1 million, then what is the tax percentage Harsh will pay on the qualified dividend based on this table? So he's single and his income is over $492,000, then the maximum tax percentage that he's going to have on the qualified dividend is going to be 20%. Let's say if Harsh is making $50,000. Yes, in most of the examination, the table will be given. So if Harsh is making $50,000, then he will fall under the 15% category. All right, tax-free distribution we have already covered. So if you have enough basis in the stock, the distribution is return of your capital. So you just reduce your basis in the stock. If you are getting more than what you had invested, then it is taxable gain for you and you need to pay taxes on it. If there is a stock split, do we know what is a stock split? What is it, Amar? Stock split means, let's say I have 10 stocks and now the company says that for each stock, I'm going to give you one more stock. Okay. So stock split basically is considered as a non-taxable transaction. So let's say that I have 10 stock of ABC company and each stock was for $10. So I have the total value of the stock is for $100. Now the company did a stock split and they said that for each stock that you have, you will get one additional stock, right? So they're splitting the stock basically. So now instead of 10, I have 20 stocks. So what is going to be my value for per stock now if it is a non-taxable transaction? Now my base for each stock is going to go down. For my 10 stocks, my value was 100. Now for 20 stocks, my value is still 100. So that means each stock is now going to value me for $5. This we have, so all this is good. Capital gain distribution, no ENP, no basis. This also we have covered. All right. Gain and loss on disposition of property. So if you are selling your property, you're selling your assets, all that needs to be reported on Schedule D. So I did miss out on the schedules that you have to report certain incomes on the different schedule. So if you have any interest and dividend, you report it on Schedule B. If you have any business income, you report it on Schedule C. If you have capital gains and losses, you report it on Schedule D. If you have any farming income, you report it on Schedule F. If you itemize your deductions, then you report it on Schedule A. So Schedule A is a schedule that you use to report expenses, but B, C, D, E, and F are for reporting your income. Schedule E, I missed out. Schedule E is where you report all your passive category income. So that means your rent, your royalties, your investments in partnerships, all that is going to get reported on Schedule E. So if you have any disposition of property that can lead to a capital gain or a capital loss, that needs to be reported on Schedule D. So amount realized minus your adjusted basis of the assets sold is going to give you gain or loss. Now, what do we mean by adjusted basis? What do we mean by basis in the first place? These are very, very basic concepts, but we are going to see this time and again in everywhere in our regulation. So basis can be our initial cost, right? Adjusted basis means the basis of the property is adjusted for any appreciation or for any depreciation. Okay. So in my example, if I took a house for $10,000 and I made a capital expenditure of $2,000, then the adjusted basis of my house is $12,000, right? And same way for machinery and equipment, if there is wear and tear, then obviously you're going to depreciate the machinery. So, whatever after depreciation, whatever the adjusted basis is the basis of your property, right? So adjusted basis minus the sale price is going to help you determine what is your gain or loss in the transaction. All right. So what have we covered so far under the gross income section? What all items did we cover so far under the gross income section? We covered salary, wages, we covered interest, we covered fringe benefits which were taxable, we covered minimal fringe benefits which are not taxable. We covered certain items which are reimbursed by your employer but not taxable. Okay. Now we move on to the IRA. Now, individual retirement account, this is kind of important because we are going to cover it under the gross income section. We are going to cover it under the, one second. We are going to cover it under the gross income section. We are going to cover it under the adjustment section, and we are going to cover it under the credit section. Okay. So that means we are covering it in 3 different sections in the same individual taxation. So you can understand that this is kind of an important concept. Now, why are we covering it under the gross income section? Why are we going to cover it under the adjustment section? And why are we going to cover it under the credit section? Okay. So when we are covering IRA under the gross income section, we are focusing that whenever there are distributions, that means when we are taking money out of these retirement accounts, whether it's going to be a taxable event for us or whether it's going to be a non-taxable event for us. Also annuities, if you invest in annuities and there are distribution out of those annuities, then whether it's going to be a income for us or it's not going to be an income for us. So remember, The focus area here is on the distribution. When we move to the adjustment section of the formula, then the focus area will be on the contribution. So if you contribute, whether you're going to get an immediate tax benefit or whether you'll be able to help reduce your taxable income or whether it's not going to help you reduce your taxable income. Make sense? Yes, no, maybe? All right. So IRA distribution. Now, if we have to look at the IRA distribution, we need to know whether the distribution is coming from a traditional IRA or the distribution is coming from a Roth IRA. Okay, IRA means individual retirement account. Now, in United States, there are many kind of IRAs, but for our examination purposes, our focus area will be on the 401k, IRA, Roth IRA, and traditional IRA. Okay. So distribution from the IRA will consist of your principal. And of course, if you are, invested your principal, there will be some earnings on the principal. So any taxable distribution from IRA are taxed at ordinary income, regardless of the type of income, such as capital gain that are earned from the funds where invested. So this is for a traditional deductible IRA. So that means that when you had contributed to a traditional IRA, you received immediate tax benefit. So, from the perspective of putting numbers to the concept, let's say every year you're putting $2,000 in a traditional IRA for the next 10 years. Okay. So what will be your principal amount in that IRA account? If you're putting $2,000 every year for the next 10 years, it's going to be $20,000. Okay. Now, every time you put $2,000 in the traditional IRA, you were able to reduce your taxable income by $2,000. So you were able to get immediate tax benefit because you were investing in a traditional deductible IRA. Now, on that $20,000 after 10 years, you also have accumulated an earnings of $5,000. So when you withdraw this entire $25,000, this entire $25,000 is going to be taxable for you. Okay. The $20,000 of the principal is going to be taxable for you. And the $5,000 earnings that you have accumulated on the principal is also going to be taxable for you. And they are all going to get taxed at the ordinary tax rate and not at a capital gain. Capital gains and qualified dividend, we use the preferential rate. So that means the tax rate on that kind of income is lesser than your normal tax rates. Okay. What is traditional non-deductible IRA? In the same example, let's say that every time I was putting $2,000 in the traditional IRA, I was not able to get a tax benefit. That is what we mean by non-deductible. That means the $2,000 that I was investing every time, I was not reaping any immediate tax benefit. It was a taxable, like it did not help me to reduce my taxable income. So now in this case, my principal that I've accumulated in the period of 10 years is $20,000 and my earnings is $5,000. Now, if I withdraw money from a traditional IRA where I was never able to get any benefits when I contributed to that IRA, what is going to be the tax implication on the principal? Do you think the IRS can tax you on the principal? No, because you never received any benefit by investing on that account. The principal was always taxable for you. So that $20,000 is going to be taxable and the remaining $5,000 is going to be not like, the $20,000 is going to be non-taxable and the remaining $5,000 is going to be taxable for you. And for Roth IRA, so Roth IRA, if you contribute in a Roth IRA, you never get any immediate tax benefit. But when distributions happen from a Roth IRA, the principal and the earnings both are non-taxable. So remember, we are talking about distributions here because we are in the gross income section. So whatever income you are receiving, we are just trying to see whether it's going to be taxable for you or not. So distribution from traditional IRA, it's a taxable event. We've already discussed that. This part is important. Taxpayers are required to take minimum distribution when they attain the age of 73. So there is an age limit when you should withdraw. You should not be withdrawing the money from a retirement plan until and unless you attain the age of 59 and a half. But there is also a minimum mandatory distribution requirement when you attain the age of 73. Okay. Roth IRA, we already know that because when you contribute, you do not get immediate tax benefit. Any distribution from the Roth IRA, the principal and the earnings, both are non-taxable. Okay. The distribution on the Roth IRA, the earnings that you have accumulated on the Roth IRA can be treated as a qualified distribution if you satisfy certain requirements. That means you had kept the money at least 5 years, from the first day of the year of your contribution, and you had taken the money out when you were 59 and a half or when you got disabled, or you took out the money as a first time home buyer, or the distribution is made to the beneficiary after the taxpayer's death. So if you satisfy, excuse me, if you satisfy these requirements, that's when it becomes a non-taxable, it becomes a non-taxable event. Those distributions are treated as non-taxable. But anyway, even if it becomes a taxable event, let's say you keep the money only for 4 years, or you withdraw the money before you attain the age of 59 and a half, you'll still not be able to get any benefit. The principal still not be taxable, but the earnings will be taxable in this case. So this is basically how the taxable and the non-taxable event looks like. Non-deductible traditional IRA, principal is non-taxable, earning is taxable. Deductible traditional IRA, both principal and earning is taxable. Qualified Roth IRA distribution, principal and earnings both are non-taxable. And if it is a non-qualified Roth IRA distribution, that means you withdrew the money before the time period of 5 years, or you withdrew the money before you attain the age of 59 and a half, then the principal can never be taxable, but the earnings can be taxable. Okay. Now, this example is basically illustrating how the information is going to get reflected on your 1040. So let's go over, just take a minute to read over the facts that they have given. So automatic diagnostic and validation check is basically when you are preparing a tax return in a software and the software is throwing this error when you're entering the information. So just take a minute to read through the information. All right, so let me read it out for you. Mary, a CPA, is preparing Year 1 federal income tax return for his client. Isabel, who is 62 years old and single. Isabel received a $20,000 distribution from her IRA during the current year. Her only other source of income for the current year was interest and dividend income from mutual fund. Mary received the following message in a software diagnostic report when she was preparing Isabel's Year 1 federal income tax return. So on 1040, dividend income, box 49, qualified dividend. The amount of total ordinary dividend in box 48 that are qualified dividend are not entered in box 49. An amount must be entered in box 49 if the amount is qualified dividend is 0. Enter it as 0. So these are like the errors that you can find when you're preparing the tax return in the software. No entry was made to identify the type of IRA on box 73. The type of IRA needs to be selected from the options provided. So obviously, you need to tell the software what kind of IRA it is so that it can calculate the tax liability for you. So 1040 IRA distribution, box 74, date IRA was opened. The date of IRA was opened was incorrectly entered with only the month and day but not the year. The year the account was opened needs to be added. So you need to add the year. The date of the distribution was not entered. So you have to add the date of the distribution as well. All right. Action needed. Mary must enter the amount of the dividend that qualify for preferential capital rate in box 49, qualified dividend. The amount is provided in box 1B of the form. So this is the form that will show what is the dividend that is ordinary dividend and what is the dividend that is going to be qualified dividend. Then for the tax treatment of IRA, you will have to mention the appropriate type of IRA. If the distribution is from the Roth IRA, the preparation software needs to know the date when the IRA was opened, and if at least, it's been 5 years since the first day of the opening up the IRA so that it can calculate the taxes accordingly. Because Isabel is over 59.5, the distribution is a qualified Roth distribution that is 100% non-taxable as long as the 5-year test is met. If the test is not met, then the earnings are going to be taxable. Okay. Now, this is quite an interesting example, which we will do today. And then I will leave the forum open for any questions that you may have. Sally opened an IRA when she was 55 years old and contributed $5,000. Several years later, when the account had grown to $8,000, she withdrew $6,000 to pay for a 3-week European vacation. Sally is very fancy. I like the way she wants to live her life. Okay. So now there are 4 scenarios that are listed here. First scenario is if it is a traditional IRA, deduction was taken for the contribution. That means when Sally invested $5,000, she received an immediate tax benefit. What is going to be the tax implication of the $6,000 that she has withdrawn to take a European vacation in the first situation? The entire $6,000 is going to be taxable for Sally. Okay, because she received immediate tax benefit, the principal and the earnings on the principal is going to be taxable for her. In the second situation, traditional IRA deduction was not taken for the contribution. So that means when she invested this $5,000, she did not receive any taxable benefit, but she has grown the IRA from $5,000 to $8,000. So how do we determine out of the $6,000 what is my principal and what is my earnings? Okay, here we have to do pro rata. So what is my earnings? My earnings is $3,000. And what is my total IRA account now? My denominator is $8,000 into my $6,000. So what is my portion of the earnings? I do see someone has given the right answer. Virbal has given the right answer. Oh, excellent. Lisa, Amar, all are coming up with the right answers. So my earnings are 2,250 and the remaining section of the $6,000 is principal. So how much is going to be taxable for me in the second situation? The earnings, which is 2,250, is going to be taxable for me. Okay. Third situation, Roth IRA amount was withdrawn 4 years after the contribution. So what happens in the Roth IRA? In the traditional IRA, you have to prorate. In the Roth IRA, we consider that the earnings, that you get the principal first and then you get the earnings. So because the IRA is withdrawn before the 5 years period, the principal can never be taxed, but the earnings needs to be taxed. So here, because we consider that the money is coming from the principal first and then from the earnings, the $5,000 is going to be principal and the remaining $1,000 is going to be the earning. So $1,000 is going to be taxable for us. And what will be the implication? In the fourth scenario, where the amount is withdrawn 6 years after the contribution. So in the fourth scenario, there is going to be no taxable event. So everyone has given the answer correct for the first one. Everyone has given the answer correct for the second scenario. The third scenario also, we have $1,000 of taxable income. And for the fourth scenario, there is no tax implication. Okay. We'll do the early withdrawal penalties in our tomorrow's class. So we will pause here. And I did see so many questions in the chat window. So please post your questions now and I'll be happy to take that up. We don't have a class tomorrow. The classes are only over the weekends. I did see so many questions in the chat window. Copy paste those questions and put it so that I can answer them now. Oh, you have to keep reading it. That's why it is a CPA examination, right? Nothing comes easy. Can you please once again explain basis in the stock? Yes, absolutely. Basis in the stock is nothing but your investment in the stock. So let's say if you buy an Apple stock for $100, $100 is your basis in the stock. That's your investment in the stock. So tomorrow, if you sell the stock for $110, your investment is $100 and $10 is what you have sold over and above your investment. So $10 is going to be your capital gain and you're going to pay taxes on it. Can you please explain ex-dividend date? Yes, absolutely. I can do that, Shweta. So ex-dividend date is basically the date where the company is declaring their dividend. Okay. So you have to hold the stock in the 120 days period, which is either before the ex-dividend date or after the ex-dividend date. So 60 days. So let's say the ex-dividend date is today's date, which is 2nd of Feb 2024. So if you are holding the stock either 60 days before this date or 60 days after this date, which is the 120 days period before and after, if you satisfy the holding requirement of those 60 days plus the ex-dividend date, which is 61 days, that's when it becomes a qualified dividend for you. Like any dividend that you receive on this stock is going to be a qualified dividend for you. Sneha, if this is your first class, you have not missed out much. All my lectures are recorded. So you can go back and see the lecture for yesterday's class and just keep attending the classes and going through the content as and when we cover it, and you should be good to go. Yes, Shweta, I can repeat the schedules and we will do these schedules again, depending upon where we are in the gross receipts section. So today we covered interest and dividend. So interest and dividend is reported on Schedule B. If you have business and it's a proprietary business, it's going to get reported on Schedule C. We also covered capital gains. So that is reported on Schedule D. If you have any passive category income, it will be reported on Schedule E, and any farming income, which we'll also do shortly, is going to get reported on Schedule F. Can you explain the last scenario on the last example we did? Sure, The last example we did here, Roth IRA, amounts are withdrawn 6 years after the contribution. So if we go back to the requirements of the qualified distribution from a Roth IRA, they are saying that the distribution should be made at least 5 years after the first date of the contribution. And you should withdraw money at least when you attain the age of 59 and a half, or you're disabled, or the distribution is given to the beneficiary after the death. So now going back to the example here, in this example, the Sally opened the account when she was 55 and several years later. That means we'll consider that she's already 59 and a half when she withdrew the money. So here we are satisfying both the requirements. We are keeping the money at least for 6 years and she's withdrawing the money after 59 and a half years. So the principal and the earnings on the principal both is non-taxable for Sally. Yes, Becker books are enough to prepare you for the examination. Karan, don't spend any time right now to remember any slabs amounts. Please spend all the time and energy that you have on understanding the concept. Once you understand the concept and you have a lot of time in your hand, you can go ahead and learn the slabs. But please do not waste any time on learning the slabs right now. That's the least productive thing that you can do to yourself. Ankit has a question. I have a query on the range of phase out. Phase out is between the range, less the minimum and more than the maximum should not be phased out. Like last IRA example, please explain. Okay, so let's do a phase out. Where did we have the phase out amounts? All right. So let's take a phase out example for the US series EE bond. Okay. So we'll do an example for head of household. Let me also open it. So 91850 and 106850. So what is my range here? My range here in this example. So let's say that I am a single person and this is the modified AGI range. They say that if your interest is below the range, then it is non-taxable. If it is above the range, then it is taxable. But what happens if you fall in between the range? Okay. So first I define what is my range. So my range is $15,000. Now let's say that my AGI is 95,850. Okay, so that's my AGI. So how much am I over and above the starting of my range? So I will do this 95,850 minus 91,850. So I am over and above my range by $4,000. Okay, so that means this should be my numerator and $15,000 should be my denominator. So that means that 26.66% of my interest is going to be taxable and the remaining is not going to be taxable. So let's say that if I have got an interest of $100 out of this into this is going to be the $26, approximately $27 is going to be taxable and the remaining $73 is not going to be taxable if I fall in between the range. Does that make sense to you, Ankit? Okay. Next question, in case of employer providing educational expenses, whether expenses provided for spouse and dependent are also included or the expenses related to employees are only covered for exemptions. We will have to go back and see. I'm not very certain about that, but just read the content. I think it is only for the employee, but just read through. I'm not sure if it is also for the dependent. Okay, can you please explain what is the meaning of Roth? Just when the Roth is just a name of a individual retirement account. There is no like a meaning for a Roth. So there is traditional IRA and that's the Roth IRA. That's just a name of the individual retirement account. For FSA, we set aside the pre-tax amount for a certain time period. Can we make any changes in the time if we see won't be able to use it and it will be forfeited? So once you put that money in that account, you have to use it for qualified purposes. Okay. For medical purposes. If you don't use it for medical purposes and you withdraw it, then it becomes part of your normal income and then you pay taxes on it. Ma'am, I've started CPA course with regulation. Can you guide me to go with FAR? Mohammed, you can do whichever subject is more convenient for you, but I would recommend that you attend both the classes and then decide which one you want to go for first. Will we have authoritative literature access in examinations? Neha, I would say focus on the content first. Let's be fully prepared for the examination and then let's worry about the authoritative literature. But to answer your question, in the simulation section of the examination, you will have access to authoritative literature. All right, Chinmay, I have seen so many changes in the new book as compared to the old book. After reviewing recorded videos, one must have revised and updated. I am in USA, so how to get the books? Chinmay, I'm not sure, but you should have access to the Becker software. So there is an ebook that you can get in the Becker software. So please use that. You don't need a hard copy, but you can use the software ebook to prepare for the examination. If there is, Lisa has a question, if there is any penalty for withdrawal from FSA. So the penalty is that they will forfeit the money that you have. So you will not get that money. That's the penalty. Even with the extension for filing, the due date for payment for taxes remains the same. How does this work? I mean, what do you want here to work? I just don't get the question. But let's say that Charu Marti, that you have taxes due for the year, which is $100. So for the year 2023, your taxes that are due is $100. You have to make sure that when you are filing an extension, that is Form 4868, you pay that $100 with the extension. But you can file your tax return by October 15th. So that's how it is going to work. So you have to pay whatever you are due to pay with the extension that you're filing. Becker marking and hightings are available in online book in earlier version, which is not available. Yes, the settings have changed, Bhavin. Also, it's not very, I would say, very convenient for me to teach without the highlightings, but you see the slides that I'm sharing is also without any highlightings. So yes, they have changed the material. Okay, ma'am, for fringe benefits in case of iPhone, example, let's say 25% discount, how do we know the gross margin of the iPhone company? So usually this, if it has to be included in the gross receipt of your wages, the company is going to provide you with that benefit. The company is going to provide you with those details. Can you show us the form 1040? Yes, Yashwant, I'm not sure if you paid attention, but I did mention that I am going to go over the 1040 form once we complete most of the components of the calculations for an individual taxation. So that's when we will go ahead and go over the 1040 form. Doing it right now will not make a lot of sense, but because we have not covered a lot of sections. Amar says, ma'am, yesterday I've solved all the MCQs for M1 and Becker. Is that enough or do I need to go more? First, focus on doing everything that is there on the Becker software. If you're fully confident and you have enough time, then you can use the other sources to do additional MCQs. But for now, just focus on the content that you have and do whatever there is, available on the Becker software. Okay, so Shamba, we have a question. Who must file the tax return? What does except for married filing separately means? They do not get standard deduction, or whatever they earn, they pay taxes on it. No, everybody gets a standard deduction, Shambhavi. So let me show you the instructions for the form. 1 second. Okay. So sometimes not all the answers are, given in the book that we are referring. So you can also read the 1040 instructions that is there. So this is for the year 2023. So if you are married filing separately and you can be of any age, then if you have at least an income of $5, you should be filing the tax return. Okay. For all the other taxpayers, usually the amount is the standard deduction that is available to them. So for single, if you are making money, gross income, which is over 13,850, then you should be filing the tax return. Also, if you see, they have given the definition of the gross income. So what all is included in the gross income? Ankit, I'm not going to explain standard deduction and itemized deduction right now. We will go over that when we go to that section. Okay. We'll go by the formula. We'll not skip the formula. Anyone else has any other question? Okay. All right then. Thank you so much for being such a lovely audience and being proactively and enthusiastically, participating in the session. We will wrap up today and we will take up the next topic of our individual taxation in the next weekend, that is Saturday. So let's speak on Saturday again in the morning. And everyone have a nice Sunday. I'll speak to you again next week. Bye, everyone.